Namaste and a very warm welcome to our channel Rusty Traders. In this video of ours, we are going to discuss about 5 very important traits or qualities that one should have before they enter the stock markets. Before we begin, let me make a confession. I have made a lot of mistakes and have burned a lot of money in my journey in the stock markets. This video is an effort to ensure that you viewers do not commit the mistakes that I have made and take corrective actions well before you start your journey. So let's begin. First, very important trait or discipline that you should have is that you should always use your own capital. You should always trade and invest using your own money. Do not borrow or take any kind of debt. In the initial days, when the broker gives you the margin or leverage facilities, do not use that. Now, the reason is very simple. When you do not have your own money on the line, it is very easy to give out recommendations or tell that you should have bought this, you should have bought that, you should have waited this long, you should have covered it well before time. It is very simple and easy to do that when your money is not on the line. Once you put your money down the line and when the market does what it has to do, slowly you come to know the kind of trading behavior that you possess. Are you a trader? Are you an investor? Are you able to hold for very long periods of time? Are you a scalper? What kind of a person are you? In the sense, what kind of trading mentality do you have? It slowly appears when you put in your own capital to use. So ensure you do that. If things do not go your way, it is fine because you have never borrowed or never taken money from anybody else. So it is very important that you start initiating your journey using your own capital. Choice of instrument is the second very important point that you should consider. In the financial world, there are a lot of instruments wherein you can trade or invest. For example, currencies, commodities, stocks, futures and options, which are also called as derivatives, debt instruments. A lot of these are traded on the exchange and you can put in your money to use in any kind of instruments there. Second thing that you should consider once you have chosen the instrument is that you should understand the fundamental factors that affect the instrument. For example, you can hold a F&O instrument only till its particular expiry, whereas you can hold a particular stock, a delivery of a stock for a substantial amount of time. You should also consider the factors that affect a particular instrument. Let's say if you are trading a contract of crude oil, a lot of events that happen in the Middle East have a substantial impact on the prices of crude oil compared to, let's say, trading something like uh, a share of an escort, which is primarily or majorly more governed by local factors. So do have a thorough understanding of fundamentals of every instrument before you start trading in it. Third, and probably the most important point here, or most important quality or discipline that you should have, is have a concrete risk management strategy. Now, when we say risk management strategy, what do we mean? Risk management strategy is basically what is the amount of money that you are putting to use and what is the risk reward ratio. Now, when we talk about the amount of money that you put into use, what we are trying to say is, let's say you have a kitty of, let's say, 10 lakh rupees or 1 lakh rupees. Let's say 10 lakh rupees. Never invest more than 1% in a single trade. So what we are trying to tell you is that if you are taking a trade, when you're beginning your journey especially, do not take a trade of more than 10,000 in a single shot. Let's say if you're taking 10 trades, then you should take each trade of 10,000, 10,000, 10,000. So total amounts to 1 lakh rupees, because you have still not gauged how the market behaves. So it is very important that you do not put all your eggs in a single basket and go full Monty in a single trade. The tendency would always be there to, be rich or make a lot of profits overnight. Control that temper, control that temptation to do that task or do that act. Avoid putting in more than 1% in a single trade or investment. Do not do that. Second thing, risk reward. What is risk reward? Risk reward is simple. When I'm taking a trade, what is the amount of risk, which is the loss that I'm willing to take, and what is the amount of reward or the profit that I'm willing to make. Ensure that the risk reward ratio is at least 1 is to 1.25 or more. A lot of traders out there do not venture without having a risk reward ratio of 1 is to 2. They look for trade setups wherein you have a risk reward ratio of 1 is to 2 or more, which means, let's say I bought a share of Reliance at 1800 rupees, and I'm willing to lose 200 rupees, which is I'm willing to take a stop loss of 1800 minus 200, which is 1600. That is my stop loss. And let's say I'm willing to take a profit of 400, which is 1800 plus 400, which is my target or reward, which is 2200. So my stop loss is 1600, target is 2200, which is loss is 200, profit is 400. So my risk reward is 1 is to 2. So if you get such trade setups, only then enter, or else do not take a trade. Always respect your stop losses. Be very, very disciplined. Now what we're trying to understand is, let's say you took, let's go back to a previous example. 1800 is where you entered in Reliance, and 1600 was your stop loss. So let's say if Reliance slowly approaches 1700, 1650, mind you, you want it to go to 2200, but some news comes which are not favorable for Reliance, and let's say slowly it comes down to 1650, 1620. Do not commit the mistake of changing your stop loss and putting it to 1500 or 1400. Do not violate your discipline. Yes, this trade might not go your way, but it's okay. Slowly, the whole idea is about building discipline, understanding the right trade setup, and then moving on. Once you have the right trade setup, once you have the right risk management strategy, then the whole game is only about volumes. Today you might trade 10, but once you have a proper risk management strategy, you might even trade 1000 shares. So be very, very disciplined. Respect your stop losses. Fourth, and this is the whole fundamental reason why the whole stock markets runs, because one individual thinks that the market will go down, another thinks that the market is going to go up, and that is where the market gets created. And it is all driven by emotions, primarily of greed and fear. The person who is greedy, he will think that the stocks are going to go up and hence he buys. The person who is fearful thinks that the market will go down and hence he sells. That is how the markets are created. Always understand that stock market is not everybody's cup of tea. It is very violent, and it will butcher people, in the sense that you'll get chopped off. In the sense, let's say you think the market's gonna go up, you take a bullish position, and no, it does not go your way, your stop losses get hit. Let's say if you are bearish, you take a short positions, and then, oh, some good news comes, the trade setup is not right, it will go up, and then again the stop losses get hit. So all these things are the nature of the stock markets, and you have to get used to it. You should never get carried away by success or disappointed by failures. What we are trying to understand here is, let's say you took 5 trades and you got 5 of them precisely correct. Now I've seen a lot of people who are like, oh my, they believe that they are the masters, they are the stalwarts of the stock markets, and then they start violating their rules. They put all their money in a single trade, use leverage, and then that particular trade does not go their way. They do not put stop losses, and then the emotions kick in, they change their stop losses, they move their targets away, they take more leverage, and then ultimately they get butchered. And this is how a lot of people in the stock markets have gone in a very, very bad situation financially. So do not do that. Second thing is, in the markets, if things do not go your way, it has a cascading effect on your professional and a social life also. So unless and until you have a thorough or a concrete emotional base, do not venture out. In the markets, there will be very violent moves on either side, and it requires that you are very emotionally stable and have a proper risk management strategy. If you have a proper risk management strategy, which means that you have put a stop loss which is equivalent to loss that you are willing to take, and if it gets hit, you are fine with it. The problem arises when you take leverage, when you put in a lot of money and you do not have a proper stop loss or management strategy, that is what burns a hole in your pocket. So ensure that you do not do it, and you are very, very emotionally sound, and you know that the markets are very unpredictable in nature, and they are all about probabilities. So unless until you have a grasp on all these things, it is wise to stay away. You should never be emotionally attached to the trades or investments. So what we are trying to say here is, when you enter a trade, you have always, or rather you have already gauged the amount of loss that you are willing to take and the amount of target you are willing to have. Once you have that into place, if one of them gets hit, either it's the target or the stop loss, you should move out. It is as simple as that. I entered at 10 rupees, I had a target of 12 rupees, stop loss was 9 rupees, 12 rupees got hit, and hence I'm going to move out. Now if this thing goes from 12 to 22 or 32, you are not worried about it. Once it goes to 22 or 32, sometimes it may happen, sometimes it may not happen. It does not mean that you violate your own discipline and change your risk management strategy. Do not do that. A lot of time it might touch 12, and then it might touch 4 or 5 also. So do not do that. Always have a thorough understanding or idea of your stop losses and your targets. If you respect that, in the longer run you will make money. If you have a proper risk management strategy, you will make money in the longer run. The final point here is that you should always have a nag of upgrading yourselves at each and every point in time. The market behaves in a very different way. Obviously there are repetitive patterns out there, but it takes learning to identify those patterns. And always remember that there is no substitute to learning. People who have made a lot of money, like Warren Buffett, even Rakesh Junjunwala, they keep themselves abreast of things that are happening on the ground each and every day. So ensure that you also have or make a habit of continuous learning at each and every point in time. I want everybody to have this quality of looking back at your loss making trades at the end of the day and see as to where did you go wrong and take corrective actions. It is very important that this habit comes to you very early in your trading journey. Please, please cultivate this habit of looking at your trades. Once the market gets over, just sit back and see which trades were profitable for you, which trades were not, and why did this thing did not go your way, the loss making trades. Was it because of any news? Was it because you violated your own risk management strategy? You did not put a stop loss? Did greed take over? What was it? It is very important that you do this at each and every point in time. You should always have a blend of fundamental and technical analysis. I want everybody to have at least a brief idea of technicals and fundamentals, in the sense you should know how to watch candlesticks, you should know how to read charts, indicators, some part of balance sheets, profit and loss statement. If you are a trader, probably the bias will be more towards technicals. If you are an investor, probably the bias will be more toward fundamental analysis. The proportions might change, but fundamental and technical analysis together are very, very necessary to trade or invest in the stock markets. Always remember this, that you should have your strategy tested before you jump in with heavy volumes. Let's say you found a trade setup, let's say you found a pattern. For example, there are a lot of patterns out there, technical patterns. So let's say you are new to a pattern called head and shoulders. So you have found out a pattern and you have put in your money with a proper stop loss and a target. So you should test this for at least 2 to 3 months and see if this pattern is working out the way you want it. If you find the results profitable over a substantial amount of time, only then enter with heavy volumes. Till then, do not put in a lot of money. Do not put in a lot of money today. As always remember this, today when you are learning, probably the game will be all about 1 share, 5 shares, 10 shares, 20 shares. It's okay, But once you have a trade setup on which you have faith, a risk management strategy that you are comfortable with, once you have those things into place, then it is all about volumes. Today you are trading 10 trades, 10 shares. Tomorrow maybe you might start trading 500 shares, 1000 shares. It can only happen on once you have laid a proper foundation of a trade setup and a thorough risk management strategy backed with concrete learning setup. The whole idea of putting in this video was that I have burned a lot of money myself. I had hoped that I knew all these things well before I started my journey. I wish that you do not commit the mistakes that I have made and take necessary actions before you begin your journey. With that hope, we end the session here. And if you have liked this video, do ensure that you subscribe to our channel, you share it with your friends, and let the knowledge flow. Thanks a lot. Have a great day.